everyone, my name is Shyla Floodman. I'm with Team BC eXp Realty. Today I have with me Deborah Clark, who is an enrolled agent and also an accountant, and we're going to be talking about capital gains with investment properties and primary residence. Now, what is the deal with capital gains and primary residence?
When you sell your personal home, you may be subject to capital gains because of the increased value of your home from when you purchased it. So let's say you purchased your home for $400,000 3 years ago, and you're selling your house now, and you're selling it for $750,000. So between the $750,000 and the $400,000, you have a $350,000 capital gain. So if you are, say, a single person, you're only going to get a $250,000 exclusion from that capital gain. So you still have $100,000 of capital gains to pay tax on. There are ways to get that down, and certain ways are you will have your selling costs, so your real estate agent commissions, you can deduct that from the $100,000. Any improvements, so if you remodeled a kitchen, remodeled a bathroom, bedroom, you put in new flooring throughout the house, high-end flooring, you put on a new roof, those items there, you made an addition, those items can reduce the $100,000 to bring down what you're going to pay capital gains on. So that's what happens with personal property. So a single person can exclude $250,000, a married couple can exclude $500,000. But please, as always, refer to your tax preparer to see your specific situation and the personal residence that you actually live in, to determine which is the best route to take for you for capital gains.
Yes, and also there's capital gains on investment properties as well. So the difference between a primary residence and then an investment property is going to be when you turn over your personal property to become an investment, like you're renting it out, or if you purchase a property and you don't have any intention of living in it, it then becomes your investment property, which then you have no intent to live on it, you're renting it out, it's your investment property. And what are those capital gains looking like?
Okay, so there's two things going on there. So if you transfer your personal residence into a rental home, you may still qualify for a portion of your $250,000 exemption or your $500,000 exemption. You must live in the home that you transferred into an investment property 2 out of the last 5 years in order to do that. And when you're making that calculation for your capital gains on that as to what the exclusion portion is, you really have to look at the number of days that you actually own the home as a personal residence and an investment property. So you total up those days, and then you get a ratio for how many days it was actually rented and how many days you actually owned it. And remember, there's still 2 out of 5 years that you actually have to live in it to get that exclusion. So then it comes down to making the calculation for how much of it can you exclude on your personal side, and how much of the capital gains that you will have to pay for the rental portion. And you will, as a rental too, you will be taking a depreciation deduction on the building portion of the rental. So any depreciation that you took over the years actually has to be added back in, and that's taxed at an ordinary tax rate. So again, you will need to talk to your tax preparer for your specific situation to look at what you're going to pay tax on the investment side, and what you can exclude on the personal side. So please always, always, always talk to your tax preparer, because every situation is different. I know there's a lot of people out there say, well, my friend Joe did this and his situation is completely different than yours, and he didn't pay any tax, but you could owe tax. So always talk about your particular situation with your tax preparer. Now, when we're talking investment properties on rental properties, it's 100% going in. You're going in as a rental property. So any gains on that will be taxed as income, yes, at either 15 or 20%, depending on your income bracket.
Yes.
So you will, again, you had the depreciation, you will have to pay ordinary income tax on that portion, but then you would pay capital gains on any gains on that rental property. So there again, you need to talk to your tax preparer, because like I said, every situation is different.
And sort of like a house hack would be for someone to purchase a property as a primary residence, live in it for 2 years and a day, as you say, and then from there rent that property out, go purchase another primary residence, and then kind of keep repeating that cycle.
You could do that, but keep in mind that you can only use that exclusion every 2 years. So every 2 years and a day, you can sell a house and do that. However, always keep in mind that that's the rule of thumb on that.
Perfect. Awesome. Thank you, Deborah. And if you have any accounting or tax questions that you want to reach out to Deborah for, how can they reach you?
They can reach me at Deborah@bos-plus.com. So it's Deborah, DEBORAH at BOS-plus.com.
All right. Thanks, Deborah.
Thank you.
Okay.
And he's not sure